Micron Technology's fiscal third quarter 2024 financial results conference call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during this session, you'll need to press star 11 on your telephone. If your question has been answered and you'd like to remove yourself from the queue, simply press star 11 again. As a reminder, today's program is being recorded. And now I'd like to introduce your host for today's program, Satya Kumar, Investor Relations. Please go ahead, sir.
Thank you, and welcome to Micron Technology's fiscal third quarter 2024 financial conference call. On the call with me today are Sanjay Mehrotra, our President and CEO, and Mark Murphy, our CFO. Today's call is being webcast from our investor relations site at investors.micron.com, including audio and slides. In addition, the press release detailing our quarterly results has been posted on the website, along with the prepared remarks for this call. Today's discussion of financial results is presented on a non-GAAP financial basis, unless otherwise specified. A reconciliation of GAAP to non-GAAP financial measures can be found on our website. We encourage you to visit our website at micron.com throughout the quarter for the most current information on the company, including information on financial conferences that we may be attending. You can also follow us on X at Micron Tech. As a reminder, the matters we are discussing today include forward-looking statements regarding market demand and supply, market and pricing trends and drivers, the impact of new technologies such as AI, product ramp plans and market position, our expected results and guidance, and other matters. These forward-looking statements are subject to risks and uncertainties that may cause actual results to differ materially from statements made today. We refer you to the documents we filed with the SEC, including our most recent Form 10-Q and the upcoming 10-Q, for a discussion of risks that may affect our future results. Although we believe that the expectations reflected in the forward-looking statements are reasonable, we cannot guarantee future results, levels of activity, performance, or achievements. We are under no duty to update any of the forward-looking statements to conform these statements to actual results. With that, let me turn the call over to Sanjay.
Thank you, Satya. Good afternoon, everyone. I'm pleased to report that Micron delivered fiscal Q3 revenue, gross margin, and EPS all above the high end of guidance ranges. Micron drove robust price increases as industry supply-demand conditions continued to improve. This improved pricing, combined with our strengthening product mix, resulted in increased profitability across all our end markets. In data center, rapidly growing AI demand enabled us to grow our revenue by over 50% on a sequential basis, and we grew share in high-margin AI-related product categories such as HBM, high-capacity DIMMs, and data center SSDs. Our mix of data center revenue is on track to reach record levels in fiscal 2024 and to grow significantly from there in fiscal 2025. Robust AI-driven demand for data center products is causing tightness on our leading-edge nodes. Consequently, we expect continued price increases throughout calendar 2024, despite only steady near-term demand in PCs and smartphones. As we look ahead to 2025, demand for AI PCs and AI smartphones and continued growth of AI in the data center create a favorable setup that gives us confidence that we can deliver a substantial revenue record in fiscal 2025 with significantly improved profitability underpinned by our ongoing portfolio shift to higher-margin products. Micron is ramping the industry's most advanced technology nodes in both DRAM and NAND. Over 80% of our DRAM bit production is now on leading-edge 1-alpha and 1-beta nodes. Over 90% of our NAND bit production is on our two leading-edge NAND nodes. 1-gamma DRAM pilot production using extreme ultraviolet lithography is progressing well, and we are on track for volume production in calendar 2025. Our next-generation NAND node is on track with high-volume production planned for calendar 2025. We experienced some operational disruptions after the recent Taiwan earthquake, but were able to recover quickly thanks to diligent efforts from Micron Taiwan team members working together with our global operations teams. Despite impacts from the earthquake, we now expect our fiscal 2024 DRAM front-end cost reductions, excluding HBM, to be in the high single-digit percentage range. We expect our fiscal 2024 NAND front-end cost reductions to be in the low teens percentage range. These cost reductions are supported by our industry-leading 1-beta DRAM and 232-layer NAND nodes. During the quarter, Micron signed a non-binding preliminary memorandum of terms, or PMT, with the U.S. government for $6.1 billion in grants under the CHIPS and Science Act. These grants support our planned leading-edge memory manufacturing expansions in Idaho and New York. Federal and state incentives, projected power cost advantages, and R&D co-location synergies will enable Micron to achieve cost-competitive, leading-edge memory manufacturing in the United States when these projects reach efficient manufacturing scale. Fab construction in Idaho is underway, and we are working diligently to complete the regulatory and permitting processes in New York. This additional leading-edge greenfield capacity, along with continued technology transition investments in our Asia facilities, is required to meet long-term demand in the second half of this decade and beyond. These investments support our objective to maintain our current bit share over time and to grow our memory bit supply in line with long-term industry bit demand. Micron retains flexibility under the PMT to manage construction and timing of supply growth in a manner that allows us to remain responsive to market conditions. Now turning to our end markets. We are in the early innings of a multi-year race to enable artificial general intelligence, or AGI, which will revolutionize all aspects of life. Enabling AGI will require training ever-increasing model sizes with trillions of parameters and sophisticated servers for inferencing. AI will also permeate to the edge via AI PCs and AI smartphones, as well as smart automobiles and intelligent industrial systems. These trends will drive significant growth in the demand for DRAM and NAND, and we believe that Micron will be one of the biggest beneficiaries in the semiconductor industry of the multi-year growth opportunity driven by AI. Most data center customer inventories have normalized, and demand from customers continues to strengthen. PC and smartphone customers have built additional inventories due to the rising price trajectory, the anticipated growth in AI PCs and AI smartphones, as well as the expectation of tight supply as an increasing portion of DRAM and NAND output is dedicated to meeting growing data center demand. Due to expectations for continued leading-edge node tightness, we are seeing increased interest from many customers across market segments to secure 2025 long-term agreements ahead of their typical schedule. In data center, industry server unit shipments are expected to grow in the mid to high single digits in calendar 2024, driven by strong growth for AI servers and the return to modest growth for traditional servers. Micron is well positioned with our portfolio of HBM, D5, LP5, high-capacity DIMM, CXL, and data center SSD products. Recently, our customers have announced their long-term AI server product roadmaps with an annual cadence of new products with significantly improved capabilities for the next several years. Micron's technology and product leadership puts us in an excellent position to support this growth. Customers continue to provide feedback that our HBM3E solution has 30% lower power consumption compared to competitors' solutions. Our HBM shipment ramp began in fiscal Q3, and we generated over $100 million in HBM3E revenue in the quarter, at margins accretive to DRAM and overall company margins. We expect to generate several hundred million million of revenue from HBM in fiscal 2024 and multiple billions of dollars in revenue from HBM in fiscal 2025. We expect to achieve HBM market share commensurate with our overall DRAM market share sometime in calendar 2025. Our HBM is sold out for calendar 2024 and 2025, with pricing already contracted for the overwhelming majority of our 2025 supply. We are making significant strides towards expanding our HBM customer base in calendar 2025 as we design in our industry-leading HBM technology with major HBM customers. We have sampled our 12-high HBM3E product and expect to ramp it into high-volume production in calendar 2025 and increase in mix throughout 2025. We have a robust roadmap for HBM and are confident we will maintain our technology leadership with HBM4 and HBM4E. Our next generations of HBM will provide further performance and capacity enhancements while we continue to evolve our industry-leading low-power innovations. We achieved full validation on our 1-beta 32-gigabit monolithic die-based 128-gigabyte high-capacity server DIMM products and are on track to achieve several $100 million of revenue from high-capacity DIMMs in the second half of fiscal 2024. Additionally, we continue to see strong interest in our industry-leading 1-beta LPDRAM in data center applications. Data center SSD is in the midst of a strong demand recovery as customers have worked through their 2023 inventory. Hyperscale demand is improving, driven primarily by AI training and inference infrastructure, and supplemented by the start of a recovery of traditional compute and storage infrastructure demand. Micron is gaining share in data center SSDs as we reach new revenue and market share records in this important product category. During the quarter, we more than tripled bit shipments of our 232-layer-based 6500 30-terabyte SSDs, which offer best-in-class performance, reliability, and endurance for AI data lake applications. We continued our leadership and innovation by becoming the first NAND vendor to supply 200-plus layer QLC for the enterprise storage market. In PC, unit volumes remain on track to grow in the low single-digit range for calendar 2024. We are optimistic that the planned Windows 10 end-of-life in 2025, the launch of Windows 12, and the introduction of new generation of AI PCs will accelerate the PC replacement cycle starting in late calendar 2024. The PC replacement cycle should gather momentum through calendar 2025 as new AI applications are rolled out. During Computex in Taiwan, we saw several announcements of next-generation chipsets and AI PCs. These devices feature high-performance neural processing unit chipsets, and we expect these devices will have 40% to 80% more DRAM content than today's average PC. Microsoft's minimum system requirement for Copilot Plus PCs, such as the Surface Pro, is 16 gigabytes of DRAM. We expect next-generation AI PCs to make up a meaningful portion of total PC units in calendar 2025, growing each year until most PCs ultimately support next-generation AI PC specs. AI PCs are also likely to require higher performance and higher average capacity SSDs than traditional PCs, aligning well with our leading technology portfolio on our 232-layer NAND with our Performance 3500 SSD and our industry-leading value QLC 2500 NVMe SSDs. Turning to mobile, smartphone unit volumes in calendar 2024 remain on track to grow in the low to mid-single-digit percentage range. Leading smartphone OEMs recently announced new AI capabilities, and we are optimistic that delivering high-quality AI experiences can accelerate the smartphone refresh cycle. Smartphones have tremendous potential for personalized AI capabilities that offer greater security and responsiveness when executed on device. Micron's leading LP5X is enabling the recent 12 gigabyte and 16 gigabyte AI phone releases at all Android Tier 1 customers, representing a 50% to 100% increase over last year's flagship models. Micron's leading mobile solutions provide the critical performance, capacity, and power efficiency needed to unlock AI capability. Our mobile DRAM and NAND solutions are now widely adopted in industry-leading flagship smartphones. In calendar Q1, we received recognition for being number one in quality by 5 of the world's leading smartphone OEMs. Qualifications are on track for our second generation 1-beta LP5X products, and we see broadening use of our 232-layer NAND, moving beyond flagship phones into high-capacity, high and mid-tier phones. Turning to auto and industrial. The automotive sector continued to experience robust demand for memory and storage, and Micron achieved a record quarter for automotive revenues. Car production volumes are returning to pre-pandemic levels, and broader adoption of intelligent digital cockpits and more advanced driver assistance capabilities are driving content growth. We anticipate further content growth as additional intelligence, including generative AI-based technologies, is adopted in vehicles. Micron continues to be a leader in automotive with high quality and industry-first product introductions. In the fiscal third quarter, we launched the world's first multi-port Gen 4 NVMe SSD in support of next-generation centralized compute architectures. In industrial and retail consumer segments, which are a smaller part of our business, we are seeing some near-term demand uncertainty from our distribution partners and end customers. We remain confident in the long-term fundamentals and growth drivers of these businesses, especially with the increasing adoption of AI in a variety of applications. Now turning to our market outlook. We forecast calendar 2024 bit demand growth for the industry to be in the mid-teens % range for both DRAM and NAND. Over the medium term, we expect industry bit demand growth CAGRs of mid-teens in DRAM and high teens in NAND. Turning to supply. We expect calendar 2024 industry supply to be below demand for both DRAM and NAND. As discussed previously, the ramp of HBM production will constrain industry supply growth in non-HBM products. Industry-wide, HBM3E consumes approximately 3 times the wafer supply as D5 to produce a given number of bits in the same technology node. With increased performance and packaging complexity across the industry, we expect this trade ratio for HBM4 to be even higher than the trade ratio for HBM3E. We anticipate strong HBM demand due to AI, combined with increasing silicon intensity of the HBM roadmap, to contribute to tight supply conditions for DRAM across all end markets. As the memory industry is still recovering from the challenging environment in 2023, this tight supply environment will help drive the considerable improvements in profitability and ROI that are needed to enable the investments required to support future growth. Micron's bit supply growth in fiscal 2024 remains below our demand growth for both DRAM and NAND. Micron will continue to exercise supply and CapEx discipline and focus on improving profitability while maintaining our bit market share for DRAM and NAND. We continue to project we will end fiscal 2024 with low double-digit % less wafer capacity in both DRAM and NAND than our peak levels in fiscal 2022. We intend to use our existing inventory to drive a portion of the bit growth supporting our revenue in fiscal 2025 to enable a more optimized use of our CapEx investments. Micron's fiscal 2024 CapEx plan will be approximately $8 billion, and WFE spending will be down year-on-year in fiscal 2024. We expect to increase our capital spending materially next year, with CapEx around mid-30s% range of revenue for fiscal 2025, which will support HBM assembly and test equipment, fab and back-end facility construction, as well as technology transition investment to support demand growth. The construction CapEx in the planned Idaho and New York greenfield fabs in fiscal 2025 will be half or more of the expected increase in total CapEx. In fact, the growth in both greenfield fab construction and HBM CapEx investments is projected to make up the overwhelming majority of the year-over-year CapEx increase. These fab construction investments are necessary to support supply growth for the latter half of this decade. This Idaho fab will not contribute to meaningful bit supply until fiscal 2027, and the New York construction CapEx is not expected to contribute to bit supply growth until fiscal 2028 or later. The timing of future WFE spend in these fabs will be managed to align supply growth with expected demand growth. I will now turn it over to Mark for our financial results and outlook.
Thanks, Sanjay, and good afternoon, everyone. Micron delivered strong results in fiscal Q3, with revenue, gross margin, and EPS above the high end of the guidance ranges provided in our last earnings call. Improving market conditions and strong price and cost execution drove the financial outperformance. Total fiscal Q3 revenue was $6.8 billion, up 17% sequentially and up 82% year-over-year. Fiscal Q3 DRAM revenue was approximately $4.7 billion, representing 69% of total revenue. DRAM revenue increased 13% sequentially, with bit shipments declining in the mid-single-digit percentage range and prices increasing by approximately 20%. Fiscal Q3 NAND revenue was approximately $2.1 billion, representing 30% of Micron's total revenue. NAND revenue increased 32% sequentially, with bit shipments increasing in the high single-digit percentage range and prices increasing by approximately 20%. Now turning to revenue by business unit. Compute and networking business unit revenue is $2.6 billion, up 18% sequentially. DRAM data center revenue more than doubled year-over-year. Revenue for the mobile business unit was $1.6 billion, down 1% sequentially as a planned decline in volume was partially offset by improved pricing. Embedded business unit revenue is $1.3 billion, up 16% sequentially, driven by record revenue in automotive. Revenue for the storage business unit was $1.4 billion, up 50% sequentially, with growth across all end markets. We achieved record data center SSD revenue, which nearly doubled sequentially. The consolidated gross margin for fiscal Q3 was approximately 28%, up over 8 percentage points sequentially, driven primarily by higher pricing and helped by product mix and cost reductions. Excluding the effects of previously written down inventories on fiscal Q2 gross margin, the sequential improvement in fiscal Q3 would have been 15 percentage points. As a reminder, previously written down inventories had no impact on fiscal Q3 gross margin and will not affect our gross margin moving forward. Operating expenses in fiscal Q3 were $976 million, up $17 million quarter-over-quarter. Continued spend discipline and ongoing operational efficiencies helped deliver operating expenses at the low end of the guidance range. We generated operating income of $941 million in fiscal Q3, resulting in an operating margin of 14%, which was up 10 percentage points sequentially and up 53 percentage points from the year-ago quarter. Fiscal Q3 adjusted EBITDA was $2.9 billion, resulting in an EBITDA margin of 43%, up 6 percentage points sequentially and up 30 percentage points, or $2.4 billion, from the year-ago quarter. Fiscal Q3 taxes were $227 million, lower than expectations at the time of our guidance, driven by one-time discrete items. Non-GAAP diluted earnings per share in fiscal Q3 was 62 cents, compared to 42 cents in the prior quarter and a loss per share of $1.43 in the year-ago quarter. Fiscal Q3 non-GAAP EPS exceeded the high end of our guidance range by 10 cents, driven by better revenue and profitability. Turning to cash flows and capital spending, our operating cash flows were $2.5 billion in fiscal Q3, representing 36% of revenue. Capital expenditures were $2.1 billion during the quarter, and we generated free cash flow of $425 million. Our fiscal Q3 ending inventory was $8.5 billion, or 155 days, a decline of 5 days from the prior quarter. Our leading-edge supply continues to be very tight for both DRAM and NAND. On the balance sheet, we held $9.2 billion of cash and investments at quarter end and maintained near $12 billion of liquidity when including our untapped credit facility. Considering our ample liquidity, return to free cash flow generation, and strong outlook, during the quarter, we repaid $650 million of debt maturing in November 2025. We ended the quarter with $13.3 billion in total debt, low net leverage, and a weighted average maturity on our debt of 2031. Now, turning to our outlook for the fiscal fourth quarter. We expect DRAM bit shipments to be flattish and NAND shipments to be up slightly in fiscal Q4. We forecast shipment growth to strengthen modestly in the November quarter. We project continued gross margin expansion. Pricing trends remain positive, supported by favorable supply-demand conditions. Portfolio mix will be an important contributor over time as HBM, high-capacity DIMMs, data center SSDs, and other high-value products increase as a portion of our mix. The high mix for our leading-edge nodes support front-end cost reductions in line with our long-term cost reduction CAGRs, excluding HBM on DRAM. Keep in mind that higher mix of HBM will offset non-HBM DRAM cost reductions, but HBM will be at accretive gross margins. We forecast operating expenses to increase sequentially in the fiscal fourth quarter due to an increase in R&D program expenses and a non-recurring Q3 asset sale gain contemplated in our Q3 guidance. We estimate fiscal Q4 tax expense of approximately $320 million. For fiscal 2025, we estimate our non-GAAP tax rate to be in the mid-teens % range. We project days of inventory outstanding to decline through fiscal 2025 and DIO to approach our target by the end of fiscal year 2025. We forecast capital expenditures to increase sequentially in the fiscal fourth quarter to approximately $3 billion. Despite this increase in CapEx, we project continued positive free cash flow in fiscal Q4. We expect full-year fiscal 2024 CapEx of around $8 billion. Record revenue and significantly improved profitability in fiscal 2025 will help support average quarterly CapEx in fiscal 2025 to be meaningfully above the fiscal Q4 2024 level of $3 billion. We expect CapEx around mid-30s% range of revenue for fiscal 2025, which will support HBM assembly and test equipment, fab and back-end facility construction, as well as technology transition investment to support demand growth. As noted earlier, half or more of the expected CapEx increase in fiscal 2025 will be to support U.S. greenfield fab construction. As we have noted in the past, the CHIPS grants, ITC, and state incentives offset a significant portion of U.S. fab CapEx investments. Receipt of some of these incentive reimbursements occur well after when we incur the spend, resulting in higher CapEx for a period while we ramp our greenfield U.S. investments. Micron will remain disciplined in our capital spending and will modulate our WFE investments to grow bit supply in line with industry demand. With all these factors in mind, our non-GAAP guidance for the fiscal Q4 is as follows. We expect revenue to be $7.6 billion, plus or minus $200 million. Gross margin to be in the range of 34.5%, plus or minus 100 basis points. And operating expenses to be approximately $1.06 billion, plus or minus $15 million. We expect tax expenses of approximately $320 million. Based on a share count of approximately 1.1 billion shares, we expect EPS to be $1.08 per share, plus or minus 8 cents. In closing, market conditions are improving with price increases driven by favorable supply-demand trends and tightness on the leading edge. Micron is executing well on leveraging our technology leadership to grow our mix of high-value solutions, especially in products that support AI applications. Finally, our leading-edge investments and productivity initiatives are delivering cost downs and operating leverage during this market recovery. We expect record revenue and significantly better profitability in fiscal 2025 to support disciplined investment to maintain stable bit share and deliver free cash flow growth. I will now turn it back over to Sanjay.
Thank you, Mark. I want to close by commending our team in Taiwan for their response to the significant earthquake in fiscal Q3. In many ways, that response exemplifies Micron, an agile, prepared team that assesses and reacts quickly, supported by a brilliant network of colleagues around the globe. That collaboration, planning, discipline, and experience are precisely what ensures Micron is so well positioned today. I look forward to our teams accelerating Micron's memory and storage leadership as AI solutions present increasing opportunities to provide greater value from data centers to the edge. Thank you for joining us today. We will now open for questions.
Certainly. And one moment for our first question. Our first question comes from the line of Krish Sankar from TD Cowen. Your question, please.
Yeah, hi. Thanks for the question. I have two questions. Sanjay, the first one is on HBM. Clearly, you're gaining traction in HBM3E. I'm just curious, how is the HBM3E yield, and how is qualification going beyond one customer? Last time you publicly said that you qualified at NVIDIA's H200. Kind of curious, how is it going with the B100 for NVIDIA? And also, along the same path, your competitors spoke about pulling in the time frame for HBM4 versus the regular 18-month cadence for HBM technology transfer. So basically, I'm curious, Sanjay, any color on HBM3E yield, qual at different customers, timing of HBM4 would help. And a quick follow-up.
So let me start off by again pointing out that we delivered over $100 million in revenue in fiscal Q3 with our HBM3E. And I'm very pleased with our team's focus on this and delivering this number. And note that this was margin accretive to our overall margins, but also to our DRAM margins. And of course, we remain very much focused on delivering several $100 million in fiscal 2024 for HBM revenue, and as I noted, multiple billion dollars in revenue. And in HBM, we are very much focused on continuing to ramp our production and also to improve our yields. And that is, of course, an important priority. And any new product that is as complex as HBM or any new technology node always has a yield ramp, and the team is extremely focused on that. So as we look ahead to 2025, we remain confident in our ability to deliver our market share consistent with DRAM share sometime in 2025. And again, very pleased with Micron's strong product of HBM3E that, as I noted, has been well recognized by our customers to have 30% better power than any competitor's product that is out there. Now, regarding your question on qualifications, of course, we are in qualifications with other customers as well. And as I noted in my remarks, that in 2025 timeframe, we expect to be broadening, diversifying our customer base as well. And HBM4, I mentioned in my remarks that we have a strong roadmap ahead for HBM4 and HBM4E, and we feel very good about our capabilities there, the roadmap that we have in front of us, and our ability to deliver leadership with HBM4 and HBM4E as well.
Got it. Thanks, Sanjay, for that. And a quick follow-up. On the NAND bit demand, you kind of mentioned that the demand bit growth is going to be in the high teens. If I remember right, last quarter, you said it's going to be in the low 20s. So I'm kind of curious, what was the delta versus last 3 months ago? Because there's a general view that AI should be helping NAND. So why is the NAND bit demand growth not going higher? Looks like it's going lower. Thank you.
So what I would tell you, Krish, is that there is really not much of a difference between the CAGR that we shared last time versus the CAGR we shared here. And I'll also tell you that we basically revised the base year for the CAGR that we used. So this time, the CAGR that we used the base year of 2023. And in 2023, as you know, we had a bit demand growth in NAND that was higher, meaningfully higher than the CAGR. So that, of course, the larger base of 2023 just somewhat changed our outlook on the overall CAGR. But you're absolutely right to note, as we have also highlighted, that data center SSDs are a good growth demand driver. And I'll just provide you some color. The data center, automotive, and industrial, these are all growing faster in terms of NAND demand versus the CAGR that we have shared. Client, mobile, and consumer, somewhat slower. But these slow-growing segments actually have also average capacity increases ahead of them. As I gave you examples of AI PCs and AI smartphones driving content growth. And we have just conservatively planned for this, perhaps, and we will continue to assess the average capacity growth in smartphone and PCs in the times ahead. And it's important that the CAGR that we highlight here, this is what we use for our capacity planning, and we want to, of course, always remain disciplined with respect to our capacity planning and very much focusing on demand-supply balance and ROI.
All right. Thanks so much, Sanjay. Very helpful. Thank you.
Thank you. And our next question comes from the line of Vivek Arya from Bank of America Securities. Your question, please.
Thanks for taking my question. Sanjay, you mentioned a 3x trade ratio of HBM to D5. What happens to this ratio as you go to higher stacks, 12 high or more? And on the other hand, what happens as you make yield improvements? Just overall, is 3x still the operative assumption for calendar 25? And just what are the puts and takes around this ratio?
Yeah, I mean, I think for HBM3E, 3x is the operative guidance here, with respect to the trade ratio. And again, just keep in mind that this already accounts for, the larger die that exists with HBM3E, given its performance and packaging and overall product expectations, as well as the of course, with the 8-die stack as well as the logic die in there, the mature yield expectations there as well. And as the yields will be ramping up for us, of course, we will be able to get the benefit on the lower cost as we go forward. But with mature yields, the trade ratio with HBM3E is about 3 times over the mature yields of D5 in the same technology node. And as you go up to HBM4, of course, the trade ratio, as we have said before, increases. It goes higher than 3. And, as you go up from 8-die stack to 12-die stack in HBM3E, of course, 12-die stack will have somewhat lower mature yields as well. That's just the nature of how, device yields work. But the operative guidance, I think, remains still 3x for HBM3E and greater than that for HBM4, inclusive of the assumption of mature yields.
Right.
And of course, our assumption of mature yields here is world-class mature yields.
Got it. And a quick follow-up, maybe for Mark. So, you're suggesting fiscal 25 could be a record in terms of sales. Why can't it be a record in terms of gross margins? What are the puts and takes of gross margins as we go into next year? So maybe give us some sense of what incremental margins can be, let's say sales are up $5 billion or $10 billion year on year, just so, we can level set our model from a gross margin perspective. Thank you.
Yeah, Vivek, we're happy to take that. We're not providing fiscal year 25 guidance yet. I can talk about some sequential improvements from here. Of course, we guided a 600 basis point increase gross margin guidance between third quarter and the guide and fourth. And that's driven by price, but also mix is beginning to become a more substantive factor in the sequential gross margin expansions. We see November quarter. We see gross margin expansion continuing up a few hundred basis points. Again, price is a factor, but also as a fourth quarter mix participating in or contributing to the increase. And that's the effect of HBM and high capacity DIMMs and other higher value products. We do expect through fiscal 25 for price to continue to increase, and we expect this favorable mix effect to continue to increase. You've seen very clearly in the third quarter and our fourth quarter guide the strength in data center, and we see that growth continuing. And then later in the year, we see replacement cycle for smartphone and PC, and then the associated content with AI picking up. So we expect that to, again, second half of the calendar year into early 25 for that to kick in. Then on the supply side, you've got just tight conditions. You've got structurally lower capacity in the industry. Inventories are trending down, which we believe ours will trend down through fiscal 25 to close to our target by the end of 25. And then just the HBM trade ratio, which Sanjay just commented on. And then, of course, I talked about in the sequential gross margin, talked about the mix that we see in the business with our higher value products, which are HBM, high capacity DIMMs, SSDs, which we've talked about. So the momentum is very strong. We've got technology leadership. We've got the best product position the company's ever had, and the manufacturing is operating very well. So well positioned for fiscal 25.
Thank you.
Thank you. And our next question comes from the line of Toshiya Hari from Goldman Sachs. Your question, please.
Hi. Thank you so much for taking the question. I had two as well. The first one on HBM. I guess recently there have been a couple of reports about you all having some yield issues. Based on your commentary, it didn't sound like you were having these issues, but just wanted to clarify that. If you could address that, that would be really helpful. And then on HBM, the second part is, so gross margins are accretive to overall corporate margins today. What are your thoughts on sort of relative profitability going into the second half of the year and into calendar 25, particularly given the fact that you have pretty good visibility as it pertains to HBM pricing?
So regarding the yields, I think I already commented that we are pleased that in the very first quarter of production, we were able to ship over $100 million of HBM revenue, and we remain focused on our goals and remain confident about our goals of delivering several $100 million of revenue in fiscal 24 and multiple $100 billion of revenue in fiscal 25, and getting to our share to be in line with our share for HBM to be in line with our DRAM share sometime in 2025. So, of course, our yield assumptions are baked in all of that, and we look to continue to work on all aspects of ramping up our capacity, and of course, we expect to improve yields as we go forward. Again, that is typical of any new technology, any new product that you ramp up. So that's what we remain focused on. And regarding the gross margin comment, maybe Mark can add some color, but as I mentioned earlier, the gross margin is accretive not only to our corporate margins, but it is also accretive to our DRAM margins. And our DRAM margins, as you know, tend to be higher than our corporate margins, which are lower because of the lower NAND margins in NAND generally in the industry.
It is helping to drive continued gross margin expansion through 25.
Okay, got it. That's helpful. And then as my follow-up, maybe one for Mark on CapEx. So you're guiding fiscal year 25 up materially. Given some of the hints that you've provided, maybe you're looking at a mid-teens billion-dollar number for fiscal 25. I know more than half of that or half of that is coming from the greenfield investments in the U.S., but how should we be thinking about your bit supply growth in fiscal 25 or calendar 25? Should we expect you guys to grow, more or less in line with the demand CAGR you have for DRAM and NAND, mid-teens and high teens respectively, or do you expect to undership relative to those ranges in fiscal 25? Thank you.
Yeah, good questions, Toshiya, and your view on CapEx. We've given enough that we don't want to guide revenue for 25 because we'll do that at a future date by quarter. But we do expect a material increase year over year. For the quarter sequentially, we'll see a meaningful step up. We were at $3 billion. We increased from 2.1 to 3 billion third quarter to fourth quarter guide. I would characterize that both on a dollar and percent basis as more than meaningful. So it'd be less than that sequentially, but we are spending more. To your question on, we are very constrained on bits, bit production, and so we will, as I mentioned in my earlier comments, we will certainly see inventory levels come down. In fact, we expect to be approaching target inventory levels by the end of 2025.
Thank you.
Thank you. And our next question comes from the line of Thomas O'Malley from Barclays. Your question, please.
Hey, guys. Thanks for taking my question. This is for Sanjay or Mark. So you've given us the fiscal year 25 kind of company guidance of several billion in HBM, and then you've kind of talked about the share that you're getting to is equivalent to that of DRAM. So you kind of solve for that market, low teens, total HBM market. I just kind of want to understand what's your view of the suppliers to that market. As it stands today, it seems like there's really two major suppliers. When you look at the out year, do you think that number changes if there's additional qualifications? Would that number change if you were to have a third qualification, aka the market be bigger? And how did you kind of come up with that total market number? Is that kind of a bottoms-up accelerator forecast? But just kind of how you're thinking about the market, and does that change, or is it contingent upon qualifications of some of your competitors?
Well, as we have said before, that we see the CAGR for HBM growth, in terms of bit growth CAGR, to be well above 50% over the next few years. So, certainly, HBM is a strong growth driver. And again, as we increase our mix of HBM going forward, it will, of course, be, continuing to be accretive to our financial performance, including margins. And we are pleased that with the strong performance that we have, we are sold out for 25 as well, with overwhelming part of our output already committed in terms of pricing. So that points to a strong position that we have in terms of continuing to work toward achieving our goal of getting to our HBM market share to be in line with DRAM share sometime in 2025. And of course, we are working with broad range of customers in qualifications, and next year we plan to be shipping to broader set of customers. Having said all of that, no question that HBM is a complex product for our customers to qualify as well. It's highly resource intensive, not just for us, but for our customers as well. And this is where we think that our strong product position, highlighting again those attributes of 30% better power than nearest competitor and better performance and really high quality, here positions us well when customers work with those resource-intensive qualifications for Micron. And that's what we are already seeing in terms of our engagement. So we feel pretty good about our plans here for HBM.
Super helpful. And then just switching gears over to the NAND side of things. Obviously, you had a competitor out in the market talking about kind of run rate industry CapEx and kind of talking about the change in industry architecture, maybe not scaling as quickly or as capital intensively as you had in the past. You obviously are talking about CapEx. A lot of your CapEx next year is going towards Greenfield and HBM. Could you talk to the remainder of that CapEx? Could you give us any color on DRAM or NAND split between that? And then do you agree with, in this instance, it was Western Digital talking about capital intensity longer term on the NAND side. Do you agree that maybe structurally you'll see a lower investment threshold in the future to kind of continue to maintain what the industry needs?
So, for us, certainly our CapEx is dominated by our DRAM-related CapEx. That's certainly HBM because it's growing as mix in the industry, and HBM is capital intensive when it comes to unique clean room requirements for HBM and in packaging and assembly, as well as test equipment. So our CapEx is dominated by that, as well as to meet the future requirements in the second half of this decade, and that involves the construction of the fabs. So NAND CapEx is, certainly a much smaller portion of our total CapEx. And we have a very strong technology position with our NAND and strong portfolio that you see, and we are continuing to shift that portfolio toward higher value solutions as well. So we certainly will remain extremely disciplined when it comes to NAND as well in terms of driving the CapEx. And we will be disciplined in terms of driving our technology node transitions, in the timing of node transitions, across the industry. I think it is, certainly helpful given the bit growth that you get from those transitions to, slow down the timing of those, the cadence of those node transitions, so that, your bit growth CAGR versus the gain of bits that you get from the wafers can be managed well. These are the kind of things we are very much focused on in order to maintain a good supply discipline, maintain supply growth that is very much in line with the demand growth and managing our CapEx here prudently. But yes, I mean, overall, our CapEx is in NAND is significantly smaller, but we remain extremely disciplined, focused on managing our supply growth in line with demand there. And again, I want to point out that with NAND, technology transitions are sufficient to meet the demand growth. We do not need the new clean room, the new greenfield fabs, the kind that are needed in DRAM. And HBM and the trade ratio of HBM with standard DRAM is a factor in the greenfield requirements only also.
Thank you. One moment for our next question. And our next question comes to the line of Christopher Danely from Citi. Your question, please.
Hey, thanks, guys. So I think you mentioned you're signing up some customers to long-term contracts. Given your belief that the pricing is going to keep going up, why sign people up to long-term contracts and potentially, miss out on some of the increased pricing, or is there some potential for wiggle room on pricing with the contracts, and it's more of a unit basis? Just curious there.
Well, the long-term contracts, really help us and customers get closer, not only with respect to, let's say, supply or pricing discussions as may be relevant to our various customer contracts, but also with respect to the technology roadmap, the product roadmap, the timing of the supply. And they are very helpful factors in building a close relationship with the customers. And you can see that, we are pointing to a substantial revenue record in 2025, of course, leveraging some of these contracts that we have put in place. And we have also pointed to a significant improvement in profitability. So I think we are well positioned in these contracts with respect to not only the supply and demand fundamentals, but also with respect to the financial aspects.
Great. Thanks, Sanjay. And then just a quick one for Mark. Mark, was the Taiwan quake impact limited to the May quarter, or is it impacting the current quarter as well?
Not a material impact, Chris.
It's just May. All right, thanks.
Thank you. And our next question comes from the line of Harlan Sur from J.P. Morgan. Your question, please.
Yeah, good afternoon. Thanks for taking my question. Enterprise SSDs are seeing really strong demand pull from AI workloads, right? The team has driven significant share gains in enterprise SSD just over the past few quarters. I think in calendar Q1, I think Micron was the number 3 global share leader in enterprise SSD. I think it's now about 20-25% of your overall NAND business. I mean, this is a position that we've never seen Micron in before. So I think first question is, are enterprise SSD gross margins accretive to your overall NAND gross margins? And then secondly, I saw your next-gen PCIe Gen 5 SSD demo at NVIDIA's GTC conference. Pretty significant performance uplift on AI workloads versus your Gen 4 SSDs. So are you qualifying these next-gen Gen 5 SSDs for AI applications? When do you expect to ship? Just wanted to understand the sustainability of your strong share position here.
Well, thank you, Harlan, for recognizing the strong momentum that Micron's data center SSD have. And, certainly our data center SSDs are accretive to our overall NAND margins. And we have really great products. I already highlighted in my prepared remarks that we saw, tripling of bits that we shipped with our 232-layer NAND AI SSDs, going absolutely toward AI data center applications. And we have a broad set of customers that we are working with in terms of growing our share. So we see when we talk about, sequentially, we had 50% increase in revenue for our data center products. Of course, that includes the benefit of our strong data center SSD roadmap. And yes, I mean, we will, of course, continue to work with our Gen 5 SSDs, in terms of working with customers for qualifying and, not prepared to discuss at this point specifics regarding timing of some of the roadmap that is in front of us for shipments. So yes, in terms of sustainability of the strong improvement to share, we are definitely with our strong product portfolio counting on it. And this will, our SSD momentum, data center SSD momentum, will absolutely contribute also toward my remarks that I said that we will increase our mix of data center revenue in fiscal year 25 as well. Of course, HBM, high-density DIMMs, these will, of course, be a big part of it, but also data center SSDs is going to be another big part of our growth in fiscal 2025 related to data center revenue.
I would just add, Harlan, that the storage business unit delivered operating profit in the quarter.
Oh, perfect. Thank you very much. Insightful.
Thank you. This does conclude the question and answer session as well as today's program. Thank you, ladies and gentlemen, for your participation. You may now disconnect. Good day. Bye, and welcome to Micron Technology's post-earnings analyst call. At this time, all participants are in listen-only mode. After the speaker's prepared remarks, there will be a question-and-answer session. To ask a question during this session, you'll need to press star 11 on your telephone. If your question has been answered and you'd like to remove yourself from the queue, simply press star 11 again. As a reminder, today's program is being recorded. And now I'd like to hand the program over to Satya Kumar, Investor Relations.
Thank you, and welcome to Micron Technology's fiscal third quarter 2024 post-earnings analyst call. On the call with me today are Sumit Sadana, Micron's Chief Business Officer, Manish Bhatia, EVP of Global Operations, and Mark Murphy, our CFO. As a reminder, the matters we're discussing today include forward-looking statements regarding market demand and supply, market trends and drivers, and our expected results and guidance and other matters. These forward-looking statements are subject to risks and uncertainties that may cause actual results to differ materially from statements made today. We refer you to documents we have filed with the SEC, including our most recent Form 10-Q and upcoming 10-Q, for a discussion of risks that may affect our results. Although we believe that the expectations reflected in the forward-looking statements are reasonable, we cannot guarantee future results, levels of activity, performance, and achievements. We are under no duty to update any of the forward-looking statements to conform these statements to actual results. We can now open the call up for Q&A.
Certainly. One moment for our first question. And our first question comes from the line of C.J. Muse from Cantor Fitzgerald. Your question, please.
Yeah, good afternoon. Thanks for taking the question. Your first question, you're ramping CapEx significantly here in fiscal 25, but it certainly sounds like Greenfield is only coming fiscal 27 at the earliest. So I guess, how do we think about you getting to your DRAM market share for HBM in 25? Is that all just conversions from DDR5, and then I guess with DDR5 supply, it would appear that will be significantly undersupplied by you guys if that's kind of the plan into 25 for you guys.
Hi, CJ, it's Manish. I'll take that, and then Mark can add some comments. But yes, the new U.S. projects both will provide DRAM bit growth only towards the latter half of the decade. We said Idaho starting in meaningful supply in 27 and New York 28 or later. So our bit growth in the near term in DRAM is going to come from the technology transitions that we have in both Taiwan and Japan. And we're still ramping our 1 beta, which is the industry's best node right now, and we expect to begin production ramp of our 1 gamma and actually implement that both in Taiwan and then eventually in Japan as well. We announced last year that we're going to be enabling EUV in Japan so that we can ramp the 1 gamma node there as well. So our bit growth in the sort of intervening period before we get to the new U.S. manufacturing sites will be driven by technology transitions in our existing footprint, and we have space and everything lined up to be able to do that.
And CJ, I would only add that we did say that through 25, and we would expect that to continue to into 26, that we would be at approaching our target levels of inventory by end of 2025. We'll be lean on inventories as we see it in 2026. We are already sort of prioritizing bits to higher value markets now, which is driving interesting customers for longer-term agreement discussions or earlier than they typically would and behavior like that.
And
Very, very.
And I think this goes without saying, but we always say, I mean, our goal is to maintain our market share, to grow our HBM share, and sometime in calendar year 25, we'll get our HBM share to match our DRAM overall bit share, and then maintain our market share from there on.
Very helpful. Just quick follow-up on HBM3E, obviously not mature product from a yield perspective. I guess when you're setting out pricing early in a yield ramp, how does that work? Do you set higher pricing knowing that you're going to have worse yields, and as that improves, you share that benefit with your customers, or is that something that you hold yourselves? How should we think about that?
Yeah, so this is Sumit here. We have these pricing agreements done for 2024, as well as most of 2025 pricing is also all done. We are sold out for 25 from a volume perspective, pricing almost done for all of 2025 as well. And the pricing is set at a level where, we expect the overall gross margin to be at robust levels, consistent with the value this product provides to our customers and the end customers. And it is obviously the most complex product that the industry has ever done. So the pricing, also contemplates that. And of course, the pricing is done in a fairly consistent way across time. And obviously, as the product ramps, the costs come down, the yields improve, then the gross margin improves over time. That's typically how it works for pretty much all the products. And the early level of gross margin is lower than what the mature yield gross margin ends up being. Despite that, and us being very early in the yield ramp of HBM, we have said that our first full quarter of production with over $100 million of revenue already achieved HBM margins that were accretive to the company margins as well as to the company's DRAM margins.
Thank you very much.
Thank you. And our next question comes from the line of Aaron Rakers from Wells Fargo. Your question, please.
Yeah, thanks for doing the after call and let me ask a question. So going on the HBM discussion a little bit further, I guess two quarters ago, I think you guys reported some prepayments. Given the agreements that you're establishing on HBM, I'm curious is there any update to the prepayments? I think it was $600 million previously these last two quarters. And then I guess as part of that, how do I think about the capacity footprint of HBM, how that's evolved over the course of this last quarter? And is there any flexibility to, move that higher, or are you just pretty much completely set for fiscal 25 at this point?
Yeah, I'll take the prepayment question, and then I'll turn it over to Manish to talk about the HBM manufacturing footprint. In terms of prepayments, we have had, like you said, some level of prepayments, and we continue to have these discussions with customers about their goals and desires to enter into these agreements with us and use prepayments as appropriate as part of the discussion and value from both sides in terms of the puts and takes on the various terms in the agreement. And so we'll continue to evaluate these sort of opportunities. Of course, as you know, in 2023, we have had a tough downturn in the industry. So as we were coming out of it, we were definitely open to some of these discussions. We remain open to some of these discussions. However, as Mark and Sanjay have provided to you in the earlier call and in the prepared remarks, our expectation is that we will fund a lot of the capital investments for next year and the growth in those capital investments for next year through our operating cash flow and still have robust growth in our free cash flow for next year. So we are going to continue to rely on that, but there can be opportunities to enter into certain unique types of arrangements with customers, and we continue to evaluate those on a case-by-case basis. And I'll turn it over to Manish to talk about the footprint.
Sure. So, Aaron, that we're coming from a very low base installed capacity for HBM, given our decision to skip HBM3 and really focus on our HBM3E, where we felt we would have product differentiation capability, which our technology and product team have really delivered, and our customers are really appreciating. But so our goal, and we set the target that to intercept our normal DRAM market share with our HBM share to match our overall DRAM market share in calendar year 25, and that's what we're marching towards. And so our investments in the unique HBM equipment, our investments in clean room space are all marching towards that, and we're on that ramp trajectory and confident in achieving that. Just keep in mind a couple of things. The clean room space that we're enabling for this HBM ramp is more complex than standard assembly clean room space. So that's one element of what we're working towards to be able to reach that goal. But the ramp is significant given where we're starting from. But we're confident we're going to be able to achieve that goal and do so with world-class quality, world-class yield, and excellent cost structure.
Thank you. And Mark, just a quick follow-up. How do you think about operating expenses as the fundamentals improve from here? I know you gave this quarter's guidance, but just curious of how you would think about the glide path, beyond this quarter.
Yeah, we did well in the quarter on OpEx, demonstrating control. Again, we're at the lower end of the guide on our OpEx. It's up in fourth quarter, as we said, and that's driven really by primarily R&D program expenses, but we also had in the third quarter, which was built into our guidance, a land sale that was about a third of would be responsible for about a third of the increase from third to fourth quarter. In November quarter, we do see OpEx ticking up again, driven principally by R&D program expenses. Great work on the NAND front. Also, number of DRAM-related activities, including HBM development. So we would expect OpEx to be up sort of mid-single digits, 4Q to 1Q, over $1.1 billion, and then some modest increase sequentially through the year in 25.
Yeah. Thank you, Mark.
Thank you. And our next question comes from the line of Srini Pajjuri from Raymond James. Your question, please.
Yeah, thank you, guys. My question is on inventories at your customers, maybe, just looking at your PC and smartphone customers, there's some talk that some of the customers pre-built some inventory ahead of the price increases. If you can talk about, what your view based on your visibility as to how much inventory they are holding. And then on the data center, it looks like the inventory correction is mostly done. I'm just curious, you talked about, some optimism about even standard server demand picking up a bit. So I was wondering if you can, comment on that as well.
Yeah, I'll comment on the data center first, and then we'll go to PCs and smartphones. On the data center side, we had been saying for some time that we expect the data center demand to start returning in the first half of calendar 2024, and that has been pretty much on target. And as the second calendar quarter or third fiscal quarter continued, we saw a strengthening of that demand in the data center, and that strong trend has continued, mainly driven by AI. It started with a lot of the demand coming from AI, and then we are starting to see, and we had mentioned this earlier, we had started to see some early signs of improvement in demand in traditional servers, and that kind of demand improvement is continuing. So that's a positive sign overall in the data center beyond just the AI servers as well. And the inventory is pretty normalized in the data center, and a lot of the demand comes with a level of urgency, and we have been trying to chase that supply because the leading edge nodes are tight. Now, we had mentioned in terms of the shape of the recovery of the industry for certain end markets that coming out of the 2023 downturn, that PCs and smartphones would pick up in terms of volume before data center, and that has been exactly how it transpired. We started seeing strength in those segments late in calendar 24, and then that strength continued into calendar Q1, etc. And so, yes, those customers have purchased and built some inventory because of three important factors. One relates to obviously the price strength that was being discussed with customers in terms of the trajectory of pricing. We have also articulated that we expect pricing to continue to increase throughout calendar 2024. And so that has been an incentive for some customers to purchase some of the volume ahead. The second factor relates to our customers' own expectations of demand growth in their business as they launch AI PCs and AI smartphones. These obviously come with higher average capacities. We have spoken about that quite a bit in our prepared remarks. And if you look at the expectations of replacement cycle-driven unit volume increases, we have fairly modest assumptions in terms of unit volume growth this year, only low single-digit percentage in PCs, mid-single-digit percentage in smartphones. And even next year, our expectations are fairly modest, but there could be upsides. Some of our customers are expecting higher levels of unit volume growth next year than what we are modeling. And so there could be upsides, and that could be driven by a stronger replacement cycle driven by these AI capabilities in smartphones and PCs. So that brings us to the third portion of their drive to build some buffer, which is that some of these customers are getting concerned about their ability to get their hands on supply next year. And this is part of what is driving some of these earlier than usual discussions on LTAs, these long-term agreements for 2025 calendar year supply, because the growth in the data center continues at a pretty robust pace. The HBM growth, as we have said earlier, with that 3-to-1 trade ratio, displaces a lot of wafers. And between HBM, high-cap DIMMs, etc., on the DRAM side, AI server growth, return of traditional server growth, and if you get any of this growth in the PC and smartphone space, pretty soon you get to a very, very quickly a scenario where the supply growth in the industry is unable to keep up with the demand growth. And that is causing customers to pull in some of these discussions about supply, and they're carrying some extra inventory to guard against that. So that's sort of the high-level perspective on that.
Great. Sumit, maybe one quick follow-up on that. You mentioned the high-cap DIMMs as one of the strong areas in the quarter. Just curious, how does high-cap DIMM, I guess, compare versus HBM in terms of the proprietary nature of the product and the complexity, and also, given that it's higher margin, seems like then in DDR, is it as good a margin as HBM? And also, do you think that sustains? And also, if you could put that into some context as to how big the SAM is, what the applications are for this particular product. Thank you.
Yeah, I think, first I'll just mention that, and this is an important clarification. I mean, we define high-cap DIMMs as anything that is more than 64 gigabyte of DIMM capacity. So 96 gigabytes, 128 gigabytes, and higher, right? So anything that is 96 gigabytes or higher, we classify that as high-cap DIMMs. Now, when it comes to high-cap DIMMs, we were one of the first ones to introduce 96 gigabyte DIMMs in the industry. And when you look at 128 gigabyte DIMMs, Micron was the first company to introduce a monolithic 32 gigabit die-based 128 gigabyte DIMM. So I know it's a mouthful, but essentially it's a DIMM made without use of TSV, right? So it is extraordinarily cost-efficient product. And we were able to demonstrate that this product actually has lower latency than TSV-based DIMMs and higher performance. And so it's a very, very good world-class product. And Micron is, really one of the first ones in the market with this. And we have a very compelling cost structure on this. Now, these products going to AI servers, I've mentioned before, these AI server growth has been very robust, and the demand has been strong for these high-cap DIMMs. And we have definitely, very accretive margins on these products compared to the company margins. And both HBM and high-cap DIMM have some of the stronger margin profiles in the DRAM portfolio, very accretive to the overall company level. But I'll also mention that obviously the rest of the company product pricing is increasing quarter on quarter, and that rest of the company portfolio pricing keeps improving the margins of the rest of the company portfolio. So that's a positive too, but these two products are very, very robust margins.
Thank you.
Thank you. And our next question comes from the line of Brian Chin from Stifel. Your question, please.
Yeah, it's Brian Chin here. Thanks for taking a few questions. Maybe just one kind of nearer term first. I know give sort of detailed P&Ls between DRAM and NAND, but maybe just kind of in terms of a crossover. Was your NAND business profitable in fiscal 3Q, or if not, do you expect it to be in fiscal 4Q? And is that low single-digit bit shipment growth guidance in NAND reflecting more of the pull forward of smartphone demand, or is that somewhat reflective of your increasing bit shipment constraint as utilization rates there fully recover?
Yeah, Brian, what we disclose, you'll see the Q tomorrow. I can say that the NAND business overall gross margins improved in the third quarter. And then at the segment level, probably the best proxy for that business is the storage business unit. And that business did deliver operating profit in the quarter, which was substantially improved from the prior quarter.
Got it. And then just that part about the forward guidance for bit shipment growth, low single digits in NAND?
Yeah, I think in terms of the growth in NAND, on a quarter-to-quarter basis, look, there are always, all kinds of ebbs and flows between quarters. And the important thing that we are trying to do is to shift our mix towards the data center. And that is obviously, a lot of demand that we are chasing at very good prices and margins compared to, the rest of the NAND portfolio. So that's what we are doing. And all of the changes that we reported in terms of our revenue, like, for example, our mobile business, you referred to the smartphone volumes. Our mobile business was down 1% in FQ3. That was all planned changes in volume and mix changes happening in our business. The overall trends for 2024 calendar year for the mobile business have been fairly stable and consistent with what we have been mentioning for several quarters now, that our expectation has been in that sell-through of mobile phones to be in that mid-single-digit percentage unit volume growth for calendar 2024. If anything, calendar 2024 Q1 numbers that were reported out of the industry in terms of sell-through are better than what the overall full-year expectation would suggest, but we are not changing our outlook at this time.
Okay, great. And maybe just for my follow-up, I think other folks have maybe tried to get at this somewhat as well, but at the expected level of CapEx you're currently communicating now for fiscal 25, and understanding that more than half of that increase is for construction CapEx, is it reasonable to expect Micron will be able to increase bit supply in that mid-teens for DRAM, maybe high teens for NAND next year, or would more investment be needed to grow in line with the market, if bit demand is at that level or even stronger next year?
So Brian, just trying to parse your question out. A couple of just clarifications. We said that more than the half or more of the increase in CapEx expected increase in CapEx between fiscal 24 and 25 will be for the U.S. construction CapEx, right? And so we do have some other ongoing facilities and work around the rest of our footprint in Asia, as I mentioned on the call earlier, to be able to enable our technology transitions. And that's really the answer, is that our technology transitions for DRAM in Japan and Taiwan, again, 1 beta continuing to ramp, and then 1 gamma being introduced in calendar year 25, those are going to be sufficient, even with a growing penetration of HBM for us, to be able to maintain our market share in that mid-teens range. And we believe we can achieve the long-term CAGR with that. As technology transitions become less efficient, as demand continues to grow and HBM penetration grows, we do, as we've said for many years, expect greenfield wafer capacity growth to be needed, and that's timed with these U.S. projects, which will be towards the latter half of the decade.
Yeah, and just to build on that, the 2025 calendar year and fiscal year for us, we expect to maintain our bit share across both DRAM and NAND, and part of those shipments will come from inventory. So you have heard Mark mention to you that our inventory will normalize by the end of 2025, and part of that inventory is going to be helping us ensure that we can maintain flat bit share next year.
Okay, thanks. Very helpful.
Thank you. And our next question comes from the line of Harsh Kumar from Piper Sandler. Your question, please.
Yeah, hey guys. When I kind of look at your long-term model and I look back a little bit, I saw that your peak margins were somewhere in the 61.5% range. Now you've got contracted pricing for HBM, sounds like for 24 and 25, but it's hard for me to think that your pricing would call for HBM gross margin to be in that range, in that 60% range, because that's what logic commands. I was wondering if you could give us an idea of what your aspirational gross margin is, and if you can, for HBM, and if you can't give us a number, maybe help us think about a framework so that we can try and get an idea of where you might be, what you might be planning for margins for HBM.
Yeah, I mean, we're obviously not disclosing our HBM margins, but you can imagine that we certainly have this view that the industry is in a tight place today. We expect to have continued price increases in 24 calendar year, and going into fiscal and calendar 25, we obviously continue to see tight and tightening industry conditions due to the growth of HBM, data center growth, all of the other segments going into AI-driven growth mode. And so, obviously, when we think about fixing pricing for all of calendar 2025 for HBM, we are going to do the pricing with that backdrop in mind that, we want to fix pricing at a level that we don't regret later. And of course, the industry is going to continue to strengthen in terms of financial performance and margins. We expect that for Micron for sure. But we are comfortable with our HBM margin profile, because of which we have been able to set these prices ahead of time. And this is a super complex product, and the margin profile justifies, that level of value that it is creating for the ecosystem.
Understood. And just a quick follow-up. You've talked about pricing locked in through 25 fiscal. Could you talk about your design visibility? How many years? Is that also 2025 as an indication of design visibility with large GPU vendors, or is your design visibility longer than that?
Yeah, we have customers that we have logged volumes with, and some of those customers are starting purchases for their platforms in 2025, and those platforms are going to continue into 2026 and beyond. So the discussion we have had earlier with you about launching with NVIDIA for 2024, and then multiple customers in 2025. Those multiple customers who we work with to launch the products in 2025 are actually going to continue into 2026 and beyond. Now, keep in mind, these all relate to the HBM3E product. The 3E product launches with 8-high, and then through the course of calendar 2025, we'll transition the mix over to 12-high. And then HBM4 comes in 2026, and then you have HBM4 going on, and then following that, a while later, you'll get HBM4E, and so HBM4E will ship through the end of the decade, late in the decade and through the end of the decade. And so we are already in very deep engagements with customers on designing HBM4 and HBM4E. And so these are long partnerships with customers. They require long cycle time, planning for IP. And as we get to HBM4E, there is going to be a very strong possibility of integration of customer IP into the base die, and that will make HBM4E more of a customized product, won't be the same product going to all customers, more of a customized HBM product. And because of that, it necessitates long-term planning and very deep R&D engagement with customers. And because of our leadership in HBM3E, where as we have mentioned before, 30% lower power consumption, leadership specs and performance. We have really great relationships with multiple HBM customers, and we are firmly engaged in their long-term designs.
Congratulations, guys, and super helpful. Thank you.
Thank you. And our next question comes from the line of Quinn Bolton from Needham & Company. Your question, please.
Thanks for taking that question. I guess I want to come back just to the ability to maintain market share with the transition to HBM memory with the high cap DIMM modules and the node transitions. I guess I think historically node transitions, you typically with the same equipment set see net wafer starts typically decline, and so it feels like you've got a lot of factors that would sort of argue for a continued net reduction in wafer starts. And so I just wondered if you could address over the next couple of years what trend should we be thinking about in terms of your DRAM, kind of wafer starts, over that period?
Sure, Quinn. So, we talked about, and have kind of given some color on what we think is an industry-wide phenomenon out of the downturn in calendar 23 and into calendar 24 now, where we, as well as others in the industry, we believe all others in the industry, did take advantage of this phenomenon that you mentioned, where as we transitioned to newer technologies, we reduced wafer start capability structurally. So that did happen, and for us and for others. Having said that, that's not something that is always going to be the case, because we, as well as the rest of the industry, did it to be able to reduce CapEx in the face of very, very weak demand and still get the benefits in terms of performance and cost reduction from the technology transitions. So, moving forward, obviously you can imagine if every year you just keep structurally reducing, that's not, that's going to have impacts on both your bit supply and your cost. So, I would not be thinking as we head into this upturn that, the industry will continue with that structural reduction year on year. You'll see investments more in line with a typical pre-downturn where we would, maintain our wafer capacity, while we make these transition investments. Now, over the, as we go towards the second half of the decade and beyond, as technology transitions become more challenging, the bit growth capability from the newer technologies is not as great as maybe previous generations. That's where we see the need for, and if we've commented before, the need for greenfield wafer capacity growth for the entire DRAM industry. And HBM and this trade ratio that we're talking about is just one aspect of that phenomena that maybe makes that more that need for new wafer capacity as we go towards the second half of the decade more important.
Yeah,
but
so it sounds
again,
like
to your core question, we feel good about, as we discussed, being able to maintain our DRAM market share even as we grow our HBM share to be in line with our overall DRAM share.
Got it. So it sounds like you've got the facility space in Japan and Taiwan to kind of increase wafer starts to allow you to maintain share.
Basically, to be able to make technology transitions while broadly maintaining our wafer starts.
Got it. Yeah. Okay, thanks. And then just to follow up on the HBM, obviously, a lot of this is being driven today by the AI accelerators, but just wondering, do you see that proliferating to CPUs like the Grace CPU? Obviously, in the Blackwell generation has some pretty significant HBM content with it. Do you see, FPGAs or network switches, anything becoming more meaningful? Or do you think this is largely AI accelerator, kind of GPU AI accelerator driven in terms of the HBM demand drivers?
Yeah, I mean, this is heavily based on the requirements of the system level performance and the type of applications that require that high level of performance. If that performance level really dictates a level of processor memory bandwidth that cannot be met easily with traditional approaches, then of course, HBM has to be considered. Thus far, it is AI servers, but there are other product categories and applications which are starting to investigate HBM. Of course, not with these many placements as you see around the GPU, because the GPU placements, 6 placements, 8 placements, 8 high, 12 high, etc., is just a lot of memory, and other applications which may contemplate using HBM may not need that many placements. It is being contemplated in other places, but obviously the bar is high because HBM is a very expensive implementation of memory, but it is also one that is very power efficient compared to doing it in other ways. And another way that companies are trying to figure out how this architecture evolves over time is to assess the mix of HBM versus DDR5 versus LP5. So LP, low power memory, is starting to make its way into the data center. Didn't used to be the way. Obviously, the RAS capabilities of LP, which is reliability, availability, and serviceability, is not the same as DDR5, and consequently requires a lot of new architectural approaches. But you've seen leaders like NVIDIA show the way in terms of using LP DRAM in their servers. So that trend is also starting as another approach. But overall, HBM usage will increase over time, but the volumes will be dominated by accelerators.
Thank you.
Thank you. And our final question for today comes from the line of Vivek Arya from Bank of America Securities. Your question, please.
Thanks for the follow-ups. Just a few clarifications on the CapEx side. So the mid-30s CapEx intensity, is that gross or net of any CHIPS funding? And are you assuming any depreciation benefits and gross margin benefits like Intel has been doing?
That's a net number, Vivek, and so we'll be providing you net numbers based on our latest assessment on when grants come in, and also when ITC is received. We will get the depreciation benefits when it's put in service, but the cash reimbursement in the case of ITC, there may be a timing difference. Well, there will be a timing difference on that compared to grants.
Got it. So the mid-30s is a net number, and gross CapEx could be higher, right, than that.
That's correct.
Got it. And then on WFE, can you give us a sense, Mark, of what was sort of the mix in CapEx in fiscal, or what is the mix in fiscal 24, and how should we conceptually think about the mix in fiscal 25?
Yeah, we did say that WFE was down in fiscal 24, like it had been in fiscal. It was down in fiscal 23, then down again in fiscal 24. We have said it'll be up in fiscal 25. However, we did say that greenfield construction is a material part of the spend in fiscal 25. But beyond that, we've not given specific WFE guidance.
I'd say, Vivek, one other thing to keep in mind is that, and we did try to provide more color, but this HBM ramp does consume, the equipment for the HBM ramps, unique equipment there, does start to make up a bigger portion as we are embarking on this ramp to be able to go from very little share towards our natural market share next year. So that is as a percentage-wise, in terms of equipment categories, HBM unique equipment is obviously going to be a very high, or the highest growth area.
And anything incremental for EUV? Sorry, please go ahead.
No, go ahead, Vivek.
I mean, we are going to be, we've talked about, we've already made some EUV investments, and we've got a pretty efficient EUV implementation plan for 1 gamma. We are going to be implementing EUV in Japan, though. That is one thing that we've guided. So EUV is in the mix of our WFE plans for ramping 1 gamma and beyond.
Okay, I'll get back in the queue. Thank you.
Thank you. This does conclude the question and answer session of today's program. I'd now like to hand the program back to Mark Murphy for any further remarks.
I just wanted to provide a bit of housekeeping for your models. In the third quarter that we just reported, DRAM bit costs were flattish. NAND was down several percent sequentially. For FY25, DRAM all-in cost mid to high single digits down long term, but HBM mix in 25 will impact cost downs, and cost downs in 25 for DRAM will be down only modestly. Thank you all for joining today's call.
Thank you. And thank you, ladies and gentlemen, for your participation in today's conference. This does conclude the program. You may now disconnect. Good day.